All right, in this lesson, we're going to be looking at purchase returns. Now, we're looking at this from the standpoint of we are the customer and we're returning some of our products to our vendor. So we're actually returning, not a customer returning to us. Now, in this lesson, we're going to show you what the journal entry looks like. This is going to have an impact on our inventory because our inventory is going to go down because we're returning the inventory, but also the amount that we are owed back from our vendor needs to be reconciled with that return. So that's what we're going to be looking at in this lesson. So to start us off a little bit, in this lesson, again, we are the company that is returning to our vendor. We are not getting returns from our customer. We'll talk about that later on. But in this lesson specifically, we are returning it to our vendor. Now, when we do return product to our vendor, two things has to happen. The first thing that has to happen is we got to reduce the inventory amount and account because that inventory is no longer in our possession. So when the inventory was received, we would have booked inventory amounts to go up because we received it. Now that we're returning it, we're going to have to reduce them down for the amount that we're actually returning. And we're going to do that amount based on how much we paid for it or we will pay for it, not necessarily what we would sell it to our customers. So that's the first thing that we're going to do. The second thing that we're going to need to do in that same transaction is we're either going to need to receive the cash, okay, or reduce how much we owe the vendor. So it kind of depends on have we paid for it yet or have we not. Now, when we talk about receive cash, it may be in the form of an accounts receivable because we haven't received the cash yet. So we've returned it, but when we return it, there's usually a lag between when we return and when we receive the cash. So this could be, although it says receive cash, it could also be an accounts receivable because we'll have to wait for a check to be issued. The other option here is if we haven't paid the bill, we do have an option to reduce the original bill by the amount that we return. Now, why would this be in play? Because usually we're going to return something within 30 days of when we purchased it. However, if we bought these items on terms, we don't have to pay the bill until 30 days after we purchase it. So there's a timing difference there. So if we go ahead and return $1,000 worth of product, we might not have paid for it yet, but we want that $1,000 to go ahead and reduce the amount that we owe. So if we owed $20,000, we now only owe $19,000 because we returned $1,000. And then when we start to pay it, we're going to pay $19,000 to our vendor. So those are the two situations that has to happen. It's either one or the other. Now, the first thing that we must figure out is, did we pay the bill for the item that you are returning yet? If we have, then the expectation is we would get a refund of our cash, okay? Now, if so, then you would assume you're getting cash back for the return. So you can either use a debit to cash or a debit to accounts receivable, okay? Now, if not, then we assume that you're getting a credit memo from the vendor, and in return, it will reduce your accounts payable account. Now, to get a little bit technical, what would usually happen is we would send the product back to our vendor. Our vendor would issue something called a credit memo. It's basically a sheet of paper that says, we are going to credit your account $1,000. And so we have a copy of that credit memo because that would be sent to us by our vendor. And then that's usually what we use it kind of like cash. We attach it to the invoice and the subsequent payment so that the payment plus the credit memo equals the amount originally due. So if the originally was due $20,000, we would submit a check for $19,000, and then we would put a copy of the credit memo of $1,000, which would give us our $20,000. So that is one way that we do it. So if you hear credit memo, it's just basically our vendor saying, hey, we're going to credit your accounts receivable on our end. And so you don't have to pay us that $1,000 because you returned that inventory. So that's the second way that this could happen. All right, so let's take a look at an example and we'll walk you through what this would look like. So company A returned $36,000 of their inventory that they received from their vendor because it wasn't to the company's expectation. The company did not pay for the inventory yet. So if they haven't paid for the inventory yet, we can assume that they're not getting cash back, but they're going to get a credit memo, which would reduce their payable to the vendor. So what has happened? What exchange has happened? Well, we gave up up inventory. So if we give up inventory, inventory is an asset. And because inventory balance is going to go down because we gave it up, we're going to credit inventory. So we're going to credit inventory for the amount that we purchased, that we returned. So in this case, $36,000. And then our debit would be the reduction in our payable amount. So we are going to reduce our payable by $36,000 because we haven't paid yet. So we're not expecting cash back yet. We're just going to reduce what we owe them for the bill. Okay, so we're going to reduce the accounts payable. So accounts payable because we no longer owe them $36,000. It's kind of like the inventory is our payment of $36,000. Now on the vendor side, they're going to reduce the receivable. So they're going to reduce the receivable by $36,000 because we don't owe them that $36,000. So it's that's how it's going to work on our end and their end. So that's how we do the journal entry for a purchase return. We'll reduce the inventory and we'll reduce the amount that we owe to our vendor. So that is a look at the purchase returns, especially when we are the company that is returning it to our vendor. So I hope you enjoyed this lesson. We'll see you in the next video. Hey guys, if you like this video, make sure you press the like button below. And if you're looking for worksheets that go along with all of these lessons, head over to my website at patrickleemsa.com or click in the link in the far right. And I've got your next lesson right over here. So just click that link and it'll take you to that video. So until then, we'll see you in the next lesson.